wake of renewed fears about sovereign debt in Europe, stocks falling on Tuesday, gold rallying. It's a perfect day for Peter Schiff, president of Europe Pacific Capital and author of several books, including How an Economy Grows and Why It Crashes. So, Peter, just what's happening in the here and now is what's going on in Greece and now spreading into Portugal. Is this the beginning of the end of this rally that we've seen the last year plus?
Well, I don't know. I mean, the market has rallied because it dropped substantially. You know, the Dow was cut in half in 2 months. And so when you have a 50% move in the stock market, you know, you're going to get a bounce, especially when you have a Federal Reserve throwing money at the market. And so you're going to have some kind of short covering bounce, oversold conditions. But a lot of people were confused. They thought that the market going up was somehow ratifying what the government had done, that the stimulus or the bailouts were good, that the economy was improving. It's not. The economy is in worse shape than it was in 2008.
It's in worse shape because a lot of economists were saying, you know what, the economy is looking better than expected. Retail sales are up, but manufacturing's up, industrial production's up.
Retail sales being up is not a good thing because consumers are buying things they can't afford. We're going deeper into debt. One of the other reasons that consumers are buying things in the stores is because they stop making their mortgage payments. And so they have all that extra cash. Meanwhile, the losses are piling up on the balance sheets of the financial institutions, and they're hidden behind phony accounting numbers, and the Fed is helping them do that. All we've done is dig ourselves into a deeper debt. We've accumulated tremendous amounts of liabilities, of debt. Our debt is growing much faster than the GDP. That debt has to be repaid with interest. And, of course, right now, we're able to finance the national debt with a teaser rate. We've got short-term financing, but when interest rates rise, we can't do that. Look what's happening in Greece. All of a sudden, short-term rates are 15%.
Right.
They were just a few 2% or 3%, not just a few months ago. The same thing will happen to the United States. We're in the same situation that they are. We're going to move up the food chain. It's not just Greece. It's not maybe just Spain or Portugal. We are in very bad shape. Sovereign credit risk in the United States is just as great, if not greater than Greece. What everybody tries to look at is the fact, well, wait a minute, Greece can't print money, so they might default. Well, the fact that we can print money doesn't mean that we don't default. It just means that we default a different way. See, the way Greece defaults is they say we can't pay, and they restructure their debt, and maybe they agree to pay 70 cents on the dollar or 80 cents or euros, on the euro. But that's a form of default. The way America might default is we will pay 100 cents on every dollar. But the dollar will lose so much value because we have to print all the money to make it good that in terms of our foreign creditors, they might get the equivalent of 50 cents on the dollar in purchasing power, or maybe less, maybe a lot less.
Right. Well, I know that is your forecast, and you've been talking about that for a long time. Have you been surprised how strong the dollar has fared the last several months, especially versus the euro, given that outlook that you're basically saying the dollar is going to hell?
Yeah,
that's sort of your fear.
Well, nothing surprises me. The dollar is just as flawed, and it will collapse. It's only a question of when. I don't think it's going to last too much longer. And the longer it takes to fall, the bigger the drop.
Right. So how are you positioned now? And I know you have separate accounts for different clients, but what's your general advice right now?
Yeah, I've been positioned the same way. For the last 10 years or so, it's been my feeling that we're on a collision course with disaster. And I think that the most prudent thing to do is avoid U.S. dollar-denominated investments to have inflation hedges. So we've been buying commodities. We have a lot of gold and silver for our clients in physical form. We own mining companies, agriculture companies, natural resource companies all around the world, up in Canada, in Australia, in Norway, in New Zealand, and we own companies. We have a lot of investments in China through Hong Kong, mainland China, Singapore, trying to capitalize on the better opportunities that exist abroad.
Right. Does it concern you how the Shanghai index has been rolling over a little bit here of late?
Yeah, a number of our stocks have gotten beaten up in the last couple of days, but they had a spectacular run in the last year. I'm not short-term focused. I'm looking at the big picture. I'm buying stocks that pay good dividends, and so I'm not too concerned. My clients are not leveraged. I don't have hedge funds.
Right.
People aren't on margin. So if the prices of the stocks go down, if people understand what they own, it shouldn't be a concern. I'm investing for the long run, and I'm trying to stay out of what I believe is going to be the real crisis.
Right. A lot of people say 2008. We already had a huge crisis.
No, that was just the beginning, right? That was the overture. The opera hasn't even played out yet. We have made it worse with the bailouts and the stimulus, but the real crisis is going to be a currency crisis. It's going to be a funding crisis, a sovereign debt crisis, and that's going to be when we have to pay the piper. when we have a huge drop in our currency, a big move up in interest rates, and this whole phony economy that we've been living in comes crashing down around us. You can't have an economy based on spending borrowed money. You can't consume your way to wealth.